Thank you everybody for joining. Welcome to our webinar. The purpose really is to discuss how to manage through crisis, specifically taking lessons through the context of the last two crises in 2008 and 2000. If you have any questions, please click the questions tab on your toolbar. We're going to have some natural points through the hour to take these questions. By way of introduction, my name is Latif Paracha. Thank you for joining. I'm a partner at M13, where we recently raised a $200 million pool of capital to invest in early stage consumer technology companies. The firm historically has made investments in great companies like Ring, Rothy's, and Daily Harvest. Previously, I was a managing director at Virgin Group, where I spent nearly a decade. I co-managed our venture strategy, which included investments in Ring, Slack, and TransferWise. And I also managed our US portfolio of Virgin companies, which included Virgin Galactic, Virgin Hotels, and many other companies. I will now hand it over to my partner, Carl, who admittedly will be the star of the show today, as I can brag on his behalf. He was able to successfully navigate both of these previous crises with his companies, and I believe his experience will be invaluable to both our entrepreneurs and hopefully to the community at large. Over to you, Carl.
Thanks, Latif. How are you today on this sunny day? It's sunny here at least. Yeah, just to introduce myself, my name is Carl Alomar. I'm also a partner at M13. I come from more of an operating background, as you can tell from the introduction that Latif just offered very kindly. I was an engineer by training, actually grew up in the UK, went to Imperial College and studied electronic engineering, which I always like to say was the CS before there was CS. And then went into technology pretty quickly, and in the late 90s started my first company, actually based out of Los Angeles. And then my second company after I did business school, after I went to Columbia Business School, based out of New York. Those are the two companies we're going to be talking about today. Obviously, with the first company, I did go through the horrors of the bubble burst in 2000, which may be a distant memory for most. And then in 2008, I was actually in a fintech business when we hit the big financial crisis. So I've had to navigate through those, definitely have developed experience and knowledge over the years. Probably would, I feel, navigate better today than I did back then, but definitely got some great learnings and lots of stuff to share, and lots of parallels to what we're experiencing today. So with that being said, Latif, you want to kind of kick it off with maybe just some thoughts on what the current situation is as we look back?
Absolutely. So let's first talk about the sobering macro environment, just to set the stage with some reality. The market has given back all its gains that it's seen over the Trump era. We've had a nice bump today, but we're roughly around 20,000, which is a 30% drawdown in just about a month. Pretty unprecedented. Unemployment is expected to be 12% by end of Q2, and GDP growth quarter over quarter is expected to be down roughly by the same amount, according to JP Morgan and Morgan Stanley, who I think are, I guess, the experts on this right now. But you're seeing a classic run on liquidity, cash is king, and there's a major sell-off across the board. And so what does that mean for us at M13? We're fortunate enough to be sitting on a good amount of dry powder in the fund we just raised. And there has always been a lag between public market drawdowns and the venture market. But make no mistake about it, tighter liquidity is an issue across the board. Declining balance sheets, declining stock prices means less IPO activity, less M&A activity, which isn't good for exits. And it's also not great for our limited partners who are managing various asset classes and pools of capital. So that's the sobering news. I think at M13, we're first and foremost really focused on making sure that during this time, our team and our portfolio companies are taking all the steps necessary to ensure their safety. We are certainly open for business and looking to deploy capital, but I think it's natural and probably appropriate right now to be more inwardly focused in times like this, ensuring our portfolio companies have a plan to really manage through these uncertain times. The firm has an investment thesis that is predicated on understanding changing consumer behavior. The COVID-19 environment, we believe, will only accelerate some of these behaviors that we believe hopefully will become permanent shifts. There are companies in our portfolio around digital healthcare like Capsule, ProGuides, which is in the esports space, and Fillmore Labs, which is in the mental wellness space. We think all these companies will benefit from this environment and accelerate, again, some of these behavior changes. We also, as a firm, are very focused on execution within our companies. We've built a whole platform around this. And in a world where the capital markets are very tight, there will be a premium on execution. And so, we like to say our model really, despite the unfortunate circumstances, our model is really designed for this kind of a changing macro environment. And we really look forward to the challenge of supporting our companies during these times. So all of our companies are dealing with adjustments to remote work, to culture. Otherwise, they all have a very unique set of challenges, whether it's around demand or supply chain. But we're working very closely with each of them, and I'm going to give it back to Carl now to talk about some of those specifics of how we're working with the companies to ensure that they're thinking through all the critical areas.
Yeah, it's interesting because I think we're going to culminate the conversation by coming back to kind of some key points that we believe are the guiding posts that the founders should think about as they go through a crisis like this, and maybe some of the learnings from 2000 and 2008 will help with that. But in summary, I think what we're trying to do is we're trying to help companies navigate the balance between offense and defense. The idea being that, it is very customary to start thinking very defensively when you go into a financial crisis situation, but there really needs to be a balance between what are actually the opportunities that these environments present to us versus the defensive mechanisms to extend runway and to protect cash on the balance sheet. And so, we're going to talk about, the real balance to that. I think in terms of how that translates and how we work with our companies is we really think about every company as an individual and standalone entity. We think about the strategies that are opportunistic, basically a full kind of strength, weakness, opportunity, and threat analysis on all these companies so that we get a good perspective of how we think that they can navigate through these troubled waters. And in doing so, some of the companies in our portfolio we recognize have a great opportunity for growth, like the ones you mentioned, Capsule and others. And other companies will honestly have to navigate a much tougher journey as their underlying business models are really impacted by what's happening with social distancing and the inability for people to kind of walk the streets and participate in day-to-day life the way that they have been historically. And so our goal is really to use our kind of operating expertise. We have a backbench of incredible operators at M13 that have really have all been parts of big successful growth businesses in different capacities, different responsibilities. And I think really deploying that resource and that set of talents to strategically help all of our portfolio companies navigate what is the right strategy, where do they focus, what are the key things to think about over the next 3, 6, 12 months as the markets readjust and get to a place where they actually stabilize and hopefully begin to, that long road towards growth again. So that's what we're trying to do. We're working hand in hand. We like to feel like we're the best partner our founders could have. That's what we want to be. And so we're working hand in hand with all of our portfolio companies, and hopefully any portfolio companies that are on this call can attest to the support we're trying to give. And obviously we just want to get better and better at that. So feedback is always helpful too. But with that said, let's maybe go into conversations about history and the learnings we can get from history. And so I don't know, Latif, you want to maybe give a little bit of context around 2000, 2008 and how those...
Back up to the macro for a minute and talk about the last two crises for a second. 2000 was a pure tech bubble. It was unique in that sense, and it didn't have a major impact on the broader economy. There wasn't a major loss of economic productivity. And you can see that in certain metrics, including unemployment, which was never greater than 6%. In 2008, we had a serious financial crisis, as many of us remember, and that was driven by Wall Street and some behavior on Wall Street that had a significant impact ultimately on Main Street. And because our banks were under threat, and liquidity that ran through the banks was under threat, that had a significant impact, much broader significant impact on our broader economy, and you saw unemployment there rise up into the double digits. So you had a bigger impact there. I think with this crisis, which is driven really by a health crisis, it's completely destroying a lot of demand on the consumer side and shutting down major parts of the economy, physical retail, dining, transportation, and interest rates are near zero. There aren't that many levers left for the government to pull to ignite us, and so that is that's a bit of a grim situation. I think that the silver lining is our banks are in much better shape than they ever have been, well, at least from 2008, which is a big positive. And also the other silver lining, honestly, that we can't forget is out of the ashes of these kinds of environments come amazing companies that drive great utility to consumers worldwide. If you think about the last crisis, obviously companies like Airbnb and Uber came out of those, but it's it would be a mistake not to kind of just take a pause and be clear that this is a very unknown environment, and probably given the layer of health crisis on top of it, makes it a bit more acute than the last two, and very hard for us honestly predict how we come out of it, when we come out of it. But most people think GDP growth will be roughly flat, this year, and if we can maintain a flat GDP, if we look at the last crisis, 2008, actually fluctuated. We had quarters where we were negative, quarters where we were slightly positive. If we can stay on that level, I think we'll be in a pretty good place as compared to the last two crises. So with that background, Carl, I think it's probably most helpful to speak specifically and zoom back into the micro and really talk through a bit of what you did during the last crisis, or we can start back in 2000 in the first crisis and go through your experiences there.
Yeah, I mean, I think the first thing I'll say is when the world is caving in on you individually, it feels like the world is caving in. And there's no real differentiation for a tech leader in 2000 versus any founder or any leader in this environment today. So hindsight is always very helpful because you can go back and you kind of look at the overall effects, and it makes it much easier to rationalize and see the path through. I'm an eternal optimist, so I always feel as though there will always be a path back, and I think that's been consistent in every previous crisis, especially in 2000. And it's just a question of how long and what the journey is to get from here to there. So back in 2000, I was 3 years into a company named Clearview Networks. Just to give you guys a little understanding of what it was. We like to think that we were the kind of the ring type of technology back in the late 90s, except it was dial-up modems in the very beginning of DSL. So we were basically capturing camera footage and digitizing that in a camera and delivering it over Ethernet into the internet to allow people to have access to remote cameras, generally oriented towards management, where we were in daycare centers for parental oversight of kids. We were in a lot of gas stations and gyms and different places like that, and we were doing great. We were 3 years in, a booming, very, very young team. I was in my early 20s at the time, so at least at that point I guess I was in my later 20s, but I was definitely in my 20s, and this was the first business that I'd managed. I never really had a formal business education, and so a lot of things I was doing, I was really doing by gut. And we were navigating through, and it was just such a supportive market of young founders like myself that really didn't know enough about what they should be doing. But in the late 90s, it was the general consensus was nothing can fail, and everybody was throwing money at everything. So that's what created the bubble, and that's what actually culminated in the disaster, which obviously we can see now.
Carl, you want to perhaps walk everyone through your financing situation and
yeah. So in in early 2000, we were raising, I guess it would be a Series B, $20 million round of investment. We'd secured it. We had, a group of, I think, 4 or 5 different VCs that were participating. We had our term sheets done, we had all the legals done, and we were literally reaching the day of final contract signature and wire transfer. And I remember this very, very clearly. It's quite funny that we actually had a fire alarm in the office. So everybody came out of the office. It was probably like 50, 60 employees at that point. And we all stood outside in the parking lot across the street while the fire alarm in the building was being resolved. And I got this phone call on my cell phone, which was the very early days of cell phones, of course. But I was phone call from my cell phone. It was I want to say it was a Monday, but it was the lead investor at the lead firm that was financing us. And they basically just said, hey, the markets just fell apart today. We just lost the bottom out of our portfolio. We're pulling back from every investment. We're not going to be able to follow through, even though we're basically at contract state. So literally the day I was about to receive $20 million, which if that had happened the week before, would have easily financially supported this business the whole way through the crisis and given us an opportunity to continue to build out through the crisis, was literally swept away from under us. And, at that point, at any point that you're raising money at that level, you're living on 2-3 months of cash in the bank, and that, you're comfortable because you got $20 million coming in, so you're not really worried about $2-3 months of cash in the bank. But the reality is that gets pulled away and suddenly becomes a very, very real thing very, very quickly. And so that loss of funding created a whole bunch of questions. First questions were, how do we get something back on the table? Do we go back to the other investors, reconstitute the round, try and close it again? What kind of delays will that cause? What kind of term adjustments will happen? And then the other consideration was, hey, is there a path to some kind of an exit or some other liquidity opportunity that gets us through this very, very immediate issue, an immediate crisis that we were facing? So even though our business was looking strong, everything was moving in the right direction, suddenly we had an incredible shortage of cash and just an inability to execute any of the plans we had on the table that we were literally about to kick off the following week. So as you can imagine, my world was caving in. I had payroll knocking down my door, and had to figure out what to do.
What did you do, Carl?
So first thing I did was I started talking to people around me and getting advice. And I think one thing that I really learned from that experience that we'll talk about more in the 2008 experience is the quality of the people you have around you and the quality of the guidance and support and advice you get is paramount to your ability to navigate. And so I was getting terrible advice. I was getting such random advice. One person was saying, hey, just fire everybody, move into your garage and try and rebuild the business from scratch. Other parts of advice were, different crazy things. Do a fire sale transaction, just try and get money in and kind of recapitalize yourself in a very, very big way. There were a bunch of 2 or 3 different companies looking to acquire us. I'd already seen that interest, so other advice was related to the acquisition path. But it was just a bunch of random advice and nothing that I could really grab onto. And so, if anything I learned from that, first of all, is even as you're building your business, before you get to situations like this, make sure you got the right people around you, because that is going to be paramount to your ability to really hear, clear and thoughtful guidance. But ultimately, what we did do is we were looking at all the options, and we saw the acquisition opportunities, even though the valuations obviously were now getting knocked down significantly compared to what they were, was the best route to ensure recapitalization and longevity of the business. And so we immediately started down that path. One of the scary things was within a few days, we had to extend our runway by a couple of months. We had to literally make a decision within a few days to let go of 30% of our staff, which was probably the most emotionally challenging part of the whole journey for me. But definitely learned a lot of things about how to do that and how to effectively, execute upon that kind of a drastic change quickly and smoothly so that you can keep the company on the tracks and continue pushing forward. So
So
again,
if I may, Carl, I want to just frame this period of time and then come back to you on, how you navigated the offers and ultimately your outcome. But to just set the stage for everybody, I mean, the number of venture capital funds at this time in 2000 dropped by a third. Performance was negative every quarter from Q4 of 2000 to Q1 of 2003. Distributions and IPOs went from nearly 500 in 2000 to 88 over the course of a year. And so this was a very, very tough time in the market. But I think there were some key things, Carl, that you were able to do, obviously, to work through this period.
yeah, yeah. One of the difficult things was, this was a period in which business models were never really taken into consideration. People just wanted momentum. They thought that, the internet was the answer to everything. So we really built a business with a very shaky business model. It was just about get as many cameras in the field as possible, build as large a network as possible. And I think what I came to realize from that, and I think what holds true to today, is ultimately your underlying business model is the most important thing you can have in your hands. The opportunities for us to navigate towards a sale was really oriented around how do we restructure this approach to market to actually be an economically viable business model? How can somebody buy this and think, oh, I have actually a model that I can just build out? And so we had to really kind of structure the conversations to make this much more attractive to somebody who was going to buy it in a down market and actually run it as a real business. I also had to think very heavily on, we didn't have $20 million anymore. Anybody who was buying this company was not going to come and pump $20 million in overnight in this market condition. So whatever the situation was, whatever the capital that was provided to the business post acquisition, we were going to have a very lean operating model. This was part of kind of letting go of 30% of our staff, but also just reconstituting the way we did business. And so we had to navigate all of that stuff in real time in a very short space of time while we were kind of convincing, these interested acquirers that once they looked under the hood, there was a real legitimate business there. We ultimately did secure an acquirer. It was, to be honest with you, relative to where we thought we were going, a modest valuation, but it did get us through the other side. They wanted the core team to stick around, so we had to sign on to stick around for the next year or two. And the key to it for me was that they had the ability to recruit a pretty senior executive to come in and kind of take the leading CEO role and allow me to kind of step back a little bit, essentially transition, and it gave me a way to potentially consolidate my position in this business and move on, go to business school and do the things I needed to do just to progress my career. So the decisions were both very oriented towards protecting the investors and the shareholders in the company and actually creating some kind of outlet for them, which we did. But also it created an outcome that allowed me to kind of naturally transition or build over the next year to a transition where I could go to business school and kind of continue in the path that I was planning to continue on. The one thing, just to kind of go back a little bit, the navigation of letting go of 30% of the staff, as I said, was probably the most emotional part of this whole process for me. And I think one of the key things I can leave people with is any managerial change, any difficult managerial change like that really has to be done swiftly and smoothly. I think the most important part of that whole process was that we literally pulled 30% of the team into a room, took 70% of the team into another room, gave the bad news quickly and swiftly, took care of people as much as we could, and then immediately focused on the 70% and made sure that they felt that they had security and that there was an opportunity and that they were still part of the journey to get through this cycle. And it wasn't easy. People lost friends in the process, not in terms of losing the friendship altogether, but lost friends that they worked with, your compatriots in the journey, and it was definitely a tough thing to navigate through.
Thanks, Carl. That's a very helpful background and overview. We're going to pause for a second. We've got some questions, so thank you for submitting those. We will go through those quickly, and then we can resume the conversation and talk about the 2008 crisis. The first question, which came from Jacob, is I'm curious what you think about retail in this market, especially those operating on thin margins. How to survive? How might this compare to the last two crises? I can take a quick shot at that one. I'm not sure by retail if you mean e-commerce or physical retail. Physical retail obviously is going to be incredibly impacted in the short term by just the fact that people can't get out and about. I think a lot of this honestly is tied to how long the crisis will persist. And it also, I think, probably indicates, I see you mean physical. So, we are investors. We don't invest a ton in pure brick and mortar retail. That's not really part of our strategy. But my opinion on physical retail is that obviously it will come back. It will be a big part of omnichannel strategy. If you look at e-commerce right now, it's roughly 15 to 17% of total retail. So still the vast majority of retail happens in the physical world. That will all come back. I think it's a question. If you've got thin margins, depending on why you have thin margins, there could be structural issues with the business. But I don't think we're going to be in an environment if you've got significant demand where there won't be a business there long term. The question I think really is, can you withstand the short term shock, and will the government at some point step up here to support all kinds of businesses with stimulus? And so I think every situation will be different, but good luck, and I hope everything works out in that regard. The next question is from Stephen, and Carl, by all means, please jump in on any of these. With potential seed angels being more closely impacted by the crisis and VCs sitting on capital, will some early mid-stage VCs look to invest at an earlier seed stage? I don't have the data in front of me on how much of that is already happening, but we do know for sure that Series A and Series B firms have been going earlier and earlier. Part of that is driven by where valuations are in the market and making sure you can get in where you can get enough ownership for every dollar invested. I think what you'll probably see, honestly, is some firms will be aggressive, but most firms probably will retreat back to their core strategy because that's what their LPs want them to do. That's what their LPs have signed up for. But also, I think it's just natural at a time like this for people to really hunker down and focus on what's core to them. So at the very early stages, some angels might be impacted, but there are a lot of seed funds out there.
Yeah,
there are a lot of funds out there. Some of them will get wiped out, but I think a lot of them will be around. But Carl, by all means.
I think there's when you say there's a lot of money in the hands of VCs right now, there is a whole category of VCs that have really turned their focus very directly towards seed investments. And so I do think that there is a whole new economy compared to maybe 5-10 years ago around angel versus VCs that play in the seed world. So I definitely think there's going to be a meaningful amount of capital still playing in that space. In general, there may be a certain level of increased conservatism around business models that people believe will survive through a downturn in the economy. But in general, if you've got a good business, keep fighting the fight. I'd say just navigate to people who have more institutional buckets of capital and need to put that money to work and want to remain active in the investing space. And there's a lot of them out there. So, I think there's an opportunity to continue doing that.
The next question is from, sorry? Was there? Okay, we'll keep moving. There's a question from JC. Our blockchain company has some proven traction. Is it okay to raise seed money during this COVID-19 situation? Absolutely. I think there's, again, a lot of venture capitalists out there. There's a lot of VCs that are focused on on crypto and the blockchain markets. Obviously, the crypto markets, like everything, is experiencing a massive sell-off. But out of the ashes come great companies, and if you're seeing traction and you're using, I don't know if it's a smart contract platform or using something that is proving to be working from a technology standpoint, I would not shy away from trying to raise capital. With that said, do I think your valuation today will be lower than perhaps in 3 or 6 months? If you have enough kind of capital on hand and cash on hand to just continue to build, that's a decent option as well, because valuations today again are probably a little lower than they were 2 weeks ago, and will be a little, depending on the duration of the impact here, should be higher going forward in several months from now. So I think it's up to you, honestly, on that question. But if you got the traction, I would really go for it. And I would make one side note, which is the 2000 crisis to me, which was the beginning basically of the internet and the bubble of the internet, really paved the way for e-commerce and a bunch of other things to really take off, social media. And I feel like I don't think the crypto world will get destroyed the same way, obviously, but I do think hopefully out of this environment will actually come real applications built on the decentralized internet.
Yeah, I think the one thing I would add is just from the experience in 2000 and then again in 2008, maybe there was a little bit more of a freeze and tightening of financial markets in 2008 because there was a fundamental financial crisis, as opposed to 2000 or even what's happening today. But I would say in both scenarios, what I recognized from an operating standpoint was that it wasn't that it was just that the criteria for investing was lifted. So it wasn't that investing stopped altogether. It was just that people had higher standards and higher expectations. What I'm trying to infer to that is, not in all cases, but in a lot of cases, the better companies survived and still made it through investments. It was the companies that were weaker or higher risk or much more long shot options that investors shied away from. And I think that's probably also why, the legacy portfolios of those eras outperformed other areas, not only because perhaps valuations were deflated, but also because the criteria for investment was raised. And so if you really believe you have a great business and a great opportunity, then fight the fight, go and sell that opportunity. And if the investment community believes in it the way you believe in it, then you should still find the opportunity to raise capital. I would agree with Latif that be aware of the the compression on valuations. Doing it right now is probably going to have more of a depression on valuation than if you did it 3 to 6 months from now. So keeping an eye on the market and timing yourself is definitely helpful in that regard.
So just in the interest of time, we have a series of more questions. Thank you very much. I think we're going to have to get back to the agenda, and we'll try to cover off more towards the end. But Carl, let's talk about 2008, and if you could give the audience a bit of background on what you went through as once again during that crisis.
So after my 2000 experience, I moved to New York, and I went to business school at Columbia, which I know you did too, Latif. So definitely learned a lot, definitely grew a lot, and came out of that with a really kind of reinvigorated passion to build the next business. And it took me a little while to identify what that was, but in the late 2004, 2005, launched a fintech company, really catered towards trying to solve the problem of financial solutions for people who were buying goods from China. It was a very, very backwards financial market in China, and there was a lot of opportunity to kind of disrupt and create technical platforms for people to be able to manage their supply chain costs and things like that out of China. So we built a platform, we called it China Export Finance. It was financing, insurance backable buyers. AIG was our insurer, so insurance backable buyers in mainly Europe and the US, but we also did Australasia a little bit. And we launched this business, launched the product into market in 2006. And really, it was just pretty highly welcomed platform, and grew relatively quickly through to 2008, which is when we hit the financial crisis. So in 2008, I think we had about $80 to $90 million worth of business that year. And when we hit the financial crisis, I remember I was literally, I think it was my anniversary with my then girlfriend, now wife, and our headquarters was in London for this business. So it was London, New York, and Shanghai. And so from London, we went to Paris for the weekend and to go to Euro Disney. So anecdotally, I walk into Euro Disney on Monday morning, and then I get a phone call, start getting the phone calls early morning, Monday morning, about how the world was falling apart. And then I had to try and navigate how to get back to London as quickly as possible. And I don't know if there was some cloud over Europe or something, but I think the flights were canceled. So we had to try and figure out a train. It was just a big kind of trains, planes, and automobiles trying to get back to home base so that I could actually sit in the office and try and navigate what was going on. But this was really a case of the world falling apart around us. We were underwritten by AIG. We had a syndicate of banks, generally second tier banks, not top tier banks, because obviously the asset class we were working in was not necessarily top tier bankable. And so the AIG was obviously right in the firing line, right up front. And so the first thing that happened was all this fear mongering around AIG going under, which was our underlying insurance policy that really backed all of our banking relationships. And then all of the banks we were working with, being second tier banks, were under significant amount of increased pressure to pull back on their leverage to basically really tighten up their ship and kind of tighten everything up. So they all obviously got very, very thrown aback by AIG being at risk. We literally had to have AIG write a very specific letter for us to go to every bank in our syndicate to calm them and let them know that AIG was going to be there through the journey. And so what that did is that really created a lot of compression on what we would call our supply side. So our supply side was the capability for us to run this program, the banking support, the underwriting, all of the things that we had built in place that sat under our technical platform that allowed us to run this solution. What was really interesting is we had the opposite impact on the demand side. So as you can imagine, in China as it was, there was very restricted availability to any kind of financing solutions anyway. But suddenly you put the financial crisis on top of it, and we were already a high momentum business. We were just getting inundated by demand and requests on the demand side. And even though we had a couple of companies in our portfolio of customers that did actually go under pretty quickly in the process, I'd say 95% of our portfolio or more really stood strong and actually followed through with their commitments and continued to use our services and continued to fund their transactions. So our challenge was very different in this case to what we were facing in 2000. There was definitely no shortage of business opportunity. It was more about our supply chain and how we thought about, this was obviously a financial supply chain, but you can run parallels with hardware, with anything. Like, how do we actually make sure that we're able to service the customer set that we were trying to service? And that was hugely challenging in an environment that was just driving so heavily on the regulatory standpoint against making that kind of supply available to us.
And Carl, what can you talk a little bit just about, given it was a different set of challenges, more focused on supply chain, as you said, how did you navigate it, and how did you ultimately think about the same questions you had last time around, and how did that drive you to an ultimate outcome?
Yeah, so the first big difference is we did not have a cash flow issue. So we weren't in the same situation where we had to think about preserving cash or elongating our lifeline. We were well funded, and we also were generating really good income as a business. So in this scenario, we'd actually built a model that really produced a lot of cash, which was great and created a very, very different environment for us to navigate in. We were growing, so we did, I think, as I said, between 80 and 90 million in 2008. In 2009, we ultimately did 137 million that year, but I would say we had demand that would have pushed us north of 200 million in business that year. But unfortunately, we just couldn't satisfy it. So we leaned into managing our demand side, managing it in such a way that we could try and protect all the good quality growth that we had coming to us, be much more stringent about who we worked with, but try not to ever be painted with a picture of a fintech business that could not provide its service, because that would have been the death of us. So if we were going to navigate through this journey, we didn't know how long the credit freeze was going to take. And so our initial thinking was, okay, let's take on all the business we can, let's squeeze every penny we can through the system. And if we can get through, then on the tail end of it, if we've preserved our reputation and we built a go-to message being, the go-to provider of these services in market, we had an opportunity to have incredible step change growth in the business as soon as the markets opened up and we were able to get more access to capital to transact more deals. And so through 2009, that was the strategy. Lean into the growth, focus on managing customer service was really one of our big imperatives. Manage the message, make sure that people felt we were still open for business, even in this environment where everybody else was closed for business. And then on the supply side, we were just working frantically to protect our existing bank lines, make sure that these banks did not pull back from our asset class and kind of continue to support the business. And we continue to try and navigate through adding other potential banks into the syndicate, finding wherever we could, just trying to solve the supply chain issue, which was inevitably very, very difficult. And as you can tell from the numbers, not anywhere near as successful as we wanted, or we would have just been able to do a significant amount more business. So we just held on as tight as we could for a period of time. What I would say is the culmination of it all was that I think as we got into Q4 of 2009 and I started really seeing us tap out of options on the supply side, I knew that we were not going to be able to accept new business. We would have ended up having a flat year in 2010 purely because we couldn't have written the business. And I felt that that posed a real risk in our ability to maintain message and brand in market, and also a real risk in the potential, considered value of the business, whether it's a future round of investment or any liquidity opportunity. So it presented a lot of risk. So towards the end of 2009, we started seriously considering, continuing to get pressure from our banks who were trying to pull out of these credit facilities. We decided it was the appropriate time to exit and to find a partner that had the right type of balance sheet to be able to support the business we had in front of us and essentially just park the business in a place where it could continue to thrive and grow. We had ultimately ended up with two options on that, and I think we ended up in the right place. We ended up, the business ended up getting taken over by a company here in the US, a big factoring firm here in the US, and they continue to build to this day, to build the platform out of China. They have our customer base in China, and they built a pretty good business on top of their existing US business out of that. But it was hairy because even in the negotiation phase, it was very clear, I think, to all parties as we did the appropriate diligence that we were in a very difficult position. We were put in a very difficult position to negotiate. And we really had to, fight pretty hard to make sure that we ultimately had a deal that could work and we had, the right parties involved to actually allow the business to be successful. But we ultimately closed a deal in Q1 of 2010 and were able to exit the business and let the business continue to thrive and grow, under a different cap table. Under a different balance sheet.
Great. Thanks, Carl. That's super helpful. I'd like to zoom out again, just real quickly, talk about 2008. And it's like a broken record because we just talked about this in 2000, but impressive for Carl to do all that in the environment that he was in. At the time, the number of VC funds dropped from 450 to 390. Invested capital dropped from 7.7 billion in Q1 of 2008 to 3 billion in Q1 of 2009. So significant drawdown there. Distributions back to LPs in 2009 fell to the lowest level since post the 2000 crisis. The IPO market got crushed again. And so it's interesting. You're seeing a lot of parallels 2000, 2008. If you look at the funds that were invested in that time, the 2008 vintage had an IRR of a median IRR of 7.9%. You look at the following 2 years, it starts to increase 11.6% and then 15.8%. And again, that is the median. So the great performing funds did much better than all that. And so if you ask the question of what that means for us today from a venture capital asset class standpoint, distributions this year will be obviously pretty bad for most funds. 2009 vintages, if history repeats itself, which probably will not be as strong as vintages of 2020 or 2021. I think the saving grace for many investors, if they were prudent with their capital deployment during a period that was clearly very frothy, they should have a lot of dry powder to invest going forward. And in our case, we're excited to have most of our funds still available for deployment and look forward to backing bold and ambitious entrepreneurs during this phase, which again we feel very strongly that there will be tremendous companies built out of the crisis. So with that, I think we've got 15 or so minutes left. We can, I think what the best thing to do probably, Carl, is let's just focus in on a little bit of like the lessons to really distill down the lessons you learned and that we can share with the community around what to do in these scenarios.
Yeah, I think let's do that. We can go through that and then maybe save the last 5 minutes for some more questions from the audience. So yeah, just to summarize it, trying to kind of characterize what the key, let's call it 5 key things are that I walked away from these two experiences. I'd say the first one is to stay calm. The most important thing is to not have any knee-jerk reactions. Any impact of any financial crisis is very nuanced to the company that you're running, the company that you're in. And you have to really think of it in that individual case. Often what people do, especially people from the outside, I was talking about the advice I got in 2000 that was terrible, is they group everybody together and they just give one sweeping piece of advice. Say, oh, everybody needs to do X or everybody needs to do Y. And what I would say is you have to stay calm. You have to see, the details of your business and understand that there's more to it than just a sweeping statement of calamity. And there's sometimes opportunities to be identified and there's also risks to be addressed. And so that probably leads to the second piece of guidance, which is to be very strategic. So, once you're calmly settled, you're not making any knee-jerk reactions. I think the key thing is, do a full SWOT analysis on your business, strengths, weaknesses, opportunities, threats. Figure out how does this situation impact the key components of your business? How does it impact your supply chain? How does it impact your demand? How does your customer behavior change during the crisis, even following the crisis? Reassess the world around you and understand how that strategically impacts your business so that really, as we said earlier, you can balance between the offense and the defense strategy. So from an offense standpoint, you're thinking about, hey, what can I lean into that actually provides opportunity for continued growth? And on the defense side, what can I do to make sure that I'm protected and preserving, myself financially or whatever way I need to preserve myself in this environment. The one thing when you do that, that I would like to say is, the third point is beware of hibernation. So, in the traditional sense of growth companies, if you're not growing, you're dying. I think the concept here is that even if in situations where you have your business taken away from under you, we have, businesses in our portfolio that are so heavily focused on real life interactions and real life events that ultimately a significant amount of their business gets pulled away from under them. You have to recalibrate your focus and what you're doing so that the business can still maintain energy and you don't flatline. You don't just go into hibernation and then disappear and thinking you're going to be able to come back out of that. It's very difficult to come out of that after the crisis is over. So always try and think positively towards what can you do to continue driving some kind of momentum. And if it's not financial momentum, some other kind of momentum in your business through the crisis. Fiscal responsibility is what everybody will say. That'll be my fourth point. But I would make it fourth because I think being strategic, making sure you're not hibernating, all of these things become part of the consideration of when you're thinking about your fiscal responsibility. So when you're preserving cash, or you feel like you need to let go some resources in your organization, think about what that means to the opportunities you have. Are you letting go of resources that are actually potentially driving opportunity or creating revenue? Where can you pull back because the market in the world has changed versus where should you lean in because there's opportunities now that didn't exist before, or there are opportunities that just seem to be much clearer.
And I will say, sorry, Carl, I'll add on one point on that though, given your own experiences, you've got to have, what Carl I think is saying is you got to be in the right frame of mind and then make these decisions. But just like Carl had to cut 30% of his staff and did that pretty decisively in a time of crisis, I think everyone needs to be calm, be strategic, but also if you need to make a decision, it's imperative that you do so and stand behind it.
Yeah, if you're making tough decisions, you got to make them quickly and you got to make them efficiently, and then focus on the path forward. The last of the five that I put together, so just to recall: stay calm, be strategic, beware of hibernation, fiscal responsibility, and the last one is support mechanisms. And this is something that really you should pull together before you even start building your business, like right at the beginning, or before rather you hit the crisis mode. As of where we are now, it's still always helpful to try and surround yourself by good quality mentors and guides and people that can really be helpful. We at M13 try and be that for our founders. But the support mechanism and the quality of the support mechanism is incredibly valuable. I think in my 2008 experience, the key part of my experience that actually allowed me to navigate through, stay calm, and really execute and continue to grow the business is truly because I had an incredible board of directors. We put together this incredibly mature, experienced set of professionals that came, from very, very high level banking backgrounds. The ex-head of HSBC Asia, the ex-head of Fitch Ratings, those types of people, and they were incredibly supportive, incredibly influential when needed, and just stayed calm and went through the journey with us. And if you can surround yourself with that kind of support mechanism, you're going to be far better off than if you're literally in a room full of people who are panicking. So those to me are the five core guidelines: stay calm, be strategic, beware of hibernation, fiscal responsibility, and support mechanism. And I think if you can kind of think that way, it will hopefully be helpful in the process of navigating how you get through the current situation.
Great. Thank you, Carl, for that. I think we're going to end. We have a few minutes with some Q&A. There's a handful of questions. They've been broken up into some topics. One is around lending and fundraising. And so one question, Berlin and JC ask, would VCs and seed investors be attracted to lending versus equity? Do you see any startups getting loans or line of credits? And if so, under what terms? Carl, do you want to take that one?
Yeah, I mean, I would say compared to where we were 20 years ago or even 12 years ago, the venture debt community as a whole is a lot more of a significant asset class now than it was back then. And I think there's a lot of players that are much more focused on creating lending opportunities for venture-backed businesses than just simply investing. Having said that, I think they're going through the same constraints and pullbacks and reservations, risk aversion that the VC world is going through. So I don't think they want to end their business, but they're going to be much tighter on terms. They're going to, obviously be much tighter on expectations and requirements. And they'll also probably, increase their cost base to protect from the increased risk of this time. But we have, helped facilitate that for companies that we have funded. And obviously we did that in DigitalOcean as well when I was COO there. So it's a meaningful part of the capital structure of a business, and I think can be really used strategically to help. I just wouldn't say that it's any easier than the current situation that you're going to face going after VC capital as well.
I think rates are obviously very low, and you would expect that to follow through into the venture debt market. But the flip side, as Carl said, is they're going to look at your business and try to assess the level of risk, and are probably going to have a higher bar on that. Yeah. And so VC rates in total go up. We've seen that in some of our companies in terms of where lenders are asking right now. So.
Yeah, I think you'd be very, very lucky if you're able to get the benefit of the low underlying interest rates as it relates to a venture debt position. I think those are going to probably, and maybe if you're a more established business with real cash flows that you're working more through a bank, that's a likely scenario. But I think if you're going directly to venture debtors who are, not formal banks, then I think they're probably going to be considering the risk in their return profiles much more than just the underlying interest rates.
Okay, great. I think we have time for one more question. There's a handful of others, so we will try to respond to these after the fact. But there's a question, any recommendations for a startup that is not yet profitable and will probably not receive an investment in the following months? When it comes to raising money in a crisis period, how should a business go about expressing their opportunities and threats to VCs? Well, we have done well. I was going to reference the sort of SWOT analysis we did on our own portfolio companies to try to assess our view as to how they're doing, which we plan on sharing with all of them in the coming days and weeks. But I think ultimately, if you're not profitable, which means you're burning cash and you don't see an investment on the horizon, it really, I think, comes down to a couple factors. You're going to get a bit of a pass, I think, in the short term if you're a business that's predicated on consumption or some type of discretionary outdoor spend or whatever it is. You will probably, as I said, get a pass. But ultimately, what the VCs will be most focused on are the fundamentals of the business. What kind of growth can they expect once the economy comes back, or what we were able to manage through during this period? What are the unit economics and the margin profile of the business look like, and ultimately how, if you've gone through a period of contraction in your business, how have you been able to survive it? And I think if you can show real strategic action and you're able to show your ability to navigate through this period, you will be you should be able to raise capital. And I would say this is probably not the best time in the world to raise capital from a valuation standpoint. So again, if you can endure this period, come out the other side with a healthy business with real sort of growth metrics and unit economics, I think that you can actually prove during this period, you'll be in a good position to hopefully raise capital.
Yeah, Carl, I would just add. Yeah, the only thing I'd add to that is as I said before, at least my thinking around this type of thing is, it's not that every VC is closed for business. It's that the venture market is going to get more judgmental and more. I don't mean that in a bad way, but just more. Increase their set of requirements in terms of what qualifies as a viable investment. So I think the challenge is really put in the hands of the founders, such as yourselves, in terms of just presenting the most effective case possible as to why your company is worth investment. I think presenting a SWOT of the current condition is actually helpful because it tells people how you're set up to navigate in this environment. And a lot of businesses out there that we're even seeing right now are really talking about how this environment actually gives them an opportunity that, gives them an advantage at the stage that they're in. And where all is, we want to see great businesses, we want to find great founders, we want to back people through this period, but it's just going to be a question of making sure that we find the best of the best and help them really realize their dreams. So I would say keep in mind, you know, how tough this market will be as compared to maybe a year ago. But, you know, fight the fight, go out there and continue to, you know, put together the best case you can for investment and strategically figure out what the right timing is for you. As Latif says, in order to avoid too much of a discount in terms of market conditions.
I think we're out of time, everybody. Thank you so much for joining. We will post highlights at m13.co and email a copy of the webinar. So please look out for that, and please fill out our short survey and tell us what you think and how we can make this better going forward. Thank you so much for your time.
Thank you, Latif, and thank you everybody for joining.